On October 8, 1997, the boardroom of Tyco International rang with the sound of champagne corks as its CEO, Dennis Kozlowski, celebrated his 48th birthday with a $2 million extravaganza funded by the very shareholders he claimed to serve. The spectacle, gold-plated goblets, a private jet painted with the Tyco logo, and a fireworks display that lit up the New York skyline, was the opening act of a corporate drama that would explode into one of the most infamous scandals of the early 21st century. Tyco began its ascent in the 1960s as a modest manufacturer of electronic components in Princeton, New Jersey. By the early 1990s, under the relentless drive of Kozlowski and his partner, Mark Schwartz, the company had metamorphosed into a sprawling conglomerate, a conglomerate of the 1990s that spanned fire protection systems, healthcare equipment, electronics, and even the vending machine business. The strategy was simple yet aggressive: acquire undervalued firms, strip them of excess, and stitch them together under the Tyco banner, promising shareholders a relentless march toward growth. From 1993 to 1999, Tyco's revenues swelled from $5 billion to more than $30 billion, and its stock price rose in tandem, turning Kozlowski into a Wall Street darling. He was celebrated on magazine covers, lauded as a visionary who could turn any struggling asset into a profit engine. The board, dazzled by the numbers, gave him unprecedented leeway, approving deal after deal without the usual checks and balances. Tyco's annual reports read like a litany of triumphs, record earnings, strategic acquisitions, and a corporate culture that prized boldness above caution. Yet, beneath the glittering surface, warning signs flickered. In 1996, a whistleblower inside Tyco's North Carolina plant alerted auditors to irregularities in expense accounts. The internal audit team flagged excessive discretionary spending tied to executive travel and entertainment, but the concerns were brushed aside as competitive necessities. Meanwhile, a series of related party transactions began to surface. Kozlowski and Schwartz were receiving secret loans from Tyco's own subsidiaries, hidden from the public eye through a web of shell companies. The loans were not merely small favors. They amounted to tens of millions of dollars, and the terms were far more generous than any market rate. In 1998, a particularly unsettling pattern emerged in the company's financial statements. Tyco's cash flow from operations showed a steady decline, yet its reported net income continued to climb, buoyed by aggressive accounting maneuvers. The firm began using off-balance sheet entities to move debt out of the books, a tactic reminiscent of the Enron playbook that would later become a hallmark of corporate fraud. Analysts who dug deeper noted an unsettling discrepancy between the company's cash reserves and its growing dividend payouts, which seemed unsustainable in the long run. The final crack came in late 2001. A routine Securities and Exchange Commission (SEC) inquiry into Tyco's accounting practices uncovered a trove of documents that painted a starkly different picture. It turned out that Kozlowski and Schwartz had orchestrated a massive loan-to-self scheme. They had taken more than $600 million in unauthorized loans, using Tyco assets as collateral, and then concealed the transactions through a labyrinth of offshore accounts. The $2 million birthday party, once dismissed as an eccentric indulgence, was now revealed as a public display of how shareholder money was being siphoned for personal excess. When the SEC's findings went public in December 2001, the market reacted like a detonated bomb. Tyco's stock plummeted from over $100 per share to under $12 in a matter of weeks, erasing billions of dollars in investor wealth. The board, finally forced to confront the reality, fired Kozlowski and Schwartz and appointed a crisis management team to untangle the mess. The once glittering boardroom turned into a courtroom, as prosecutors charged the former CEOs with grand larceny, securities fraud, and conspiracy. The collapse of Tyco sent shockwaves through the corporate world. Investors, employees, and suppliers, many of whom had counted on the conglomerate's stability, found themselves adrift. In the wake of the scandal, Tyco was forced to sell off a swath of its businesses to raise cash and repay the misappropriated funds. The fire protection division was spun off. The healthcare arm was sold to a private equity firm, and the company's once diverse portfolio was reduced to a shadow of its former self. By 2004, Tyco had emerged from bankruptcy, but it was a leaner entity, stripped of its former glory and forever marked by the scandal that had shattered its reputation. The aftermath also sparked a wave of regulatory reforms. The Sarbanes-Oxley Act of 2002, designed to tighten corporate governance and increase transparency, found a vivid case study in Tyco's downfall. New requirements for internal controls, executive accountability, and whistleblower protections were directly influenced by the lessons learned from the Tyco debacle. In boardrooms across America, directors began insisting on independent audit committees and stricter oversight of executive compensation, hoping to prevent another Kozlowski-style excess. For the victims, shareholders who lost millions, employees who saw their pensions evaporate, and the broader public who lost trust in corporate stewardship, the scars remain. Yet, the story of Tyco also serves as a cautionary tale of how ambition, when untethered from ethics, can turn a corporate titan into a cautionary footnote. It reminds us that the glitter of growth can conceal a fragile foundation, and that the pursuit of profit without accountability can lead to spectacular ruin. Subscribe to The Collapse for more stories like this.